Imagine standing at the edge of a financial storm where every decision in Washington, every move in corporate boardrooms, and every whisper in the markets could send shockwaves across the global economy. Today, we're diving into the forces shaping your investments, your wallet, and the future of America's biggest companies. From explosive policy debates to market-moving corporate strategies, this is the moment where the stakes are higher than ever, and what happens next could redefine everything you thought you knew about money, power, and opportunity. Buckle up, because what you're about to hear will change how you see the market forever. When policymakers talk about protecting the economy, the intention often sounds noble, but markets don't respond to intentions. They respond to consequences. And right now, some of the loudest policy choices being debated are creating economic friction at the exact moment when stability matters most. Let's be clear about what's happening. Trade restrictions, tariffs, and aggressive immigration limits are not abstract political tools. They directly affect labor availability, supply chains, and pricing power across the economy. When you reduce the flow of workers into critical industries, you don't strengthen wages sustainably. You compress capacity. When you add friction to global trade, you don't create resilience. You raise costs. Those costs don't disappear. They move downstream, and consumers eventually pay the bill. Inflation doesn't always arrive with fireworks. Sometimes it shows up quietly, embedded in logistics, hidden in procurement contracts, buried inside operating margins. But markets see it. Bond yields react, input prices adjust, and capital starts demanding higher returns to compensate for uncertainty. This is not theory. This is what the data is already signaling. There's a belief that tougher trade and immigration policies automatically translate into economic strength. History suggests otherwise. Growth doesn't come from walls, it comes from flow. Capital flows, talent flows, goods flow. The most competitive economies in the world are not the most closed, they are the most adaptive. When we interrupt those flows, we introduce inefficiency, and inefficiency is inflation's closest ally. Now, some argue that these pressures are temporary, that inflation will settle as markets adjust. That assumes markets have infinite flexibility. They don't. Businesses plan years ahead. They price risk today based on policy signals tomorrow. When signals are unpredictable, investment slows. When investment slows, productivity weakens. And when productivity weakens, inflation becomes harder to contain. This is where discipline matters. Sound economic policy isn't about choosing sides. It's about understanding second-order effects. You cannot push costs higher on one side of the system and expect price stability on the other. You cannot restrict labor while demanding output growth. And you cannot undermine trade efficiency while promising consumer relief. Markets reward coherence. They punish contradiction. And right now, the contradiction is visible. Policies that claim to fight inflation while structurally feeding it. The solution isn't radical, it's rational. Policies must be evaluated not by how they sound in a debate, but by how they behave in markets. The objective should be productivity, efficiency, and long-term growth, not short-term political signaling. Because in the end, inflation doesn't care about rhetoric. It responds only to reality. And markets, as always, are already listening. When you strip away the headlines and the political theater, what we're really talking about is how a set of policy decisions, particularly on deregulation, interacts with the real economy and market psychology. There's a fundamental principle at work. Prices, productivity, and incentives don't respond to slogans. They respond to the incentives that policy actually creates. That's the crux of the message that has been circulating through major financial commentary on recent GOP positions and their effects on inflation and growth. Here's the blunt reality. When a government moves to reduce regulatory burdens, it is effectively lowering the cost of doing business. This isn't a buzzword. It has material implications for how capital is allocated, how quickly companies can hire, and how efficient those companies can be in producing goods and services. Deregulation, when done in a smart, targeted way, can unleash productivity gains precisely because it cuts out friction in the system. It allows entrepreneurs to take capital and turn it into output more efficiently. This is why deregulation is often cited as a long-term mechanism to combat inflation. Over time, improving productivity reduces unit costs, expands capacity, and ultimately, all else equal, exerts downward pressure on prices. This is not a short-term fix. Deregulation doesn't flip a switch and magically make inflation disappear overnight. But it does create a more fertile environment for economic agents, from small businesses to multinational corporations, to invest, expand, and innovate. In practical terms, that means more goods, more services, and a deeper, more resilient supply chain. It means lowering the invisible tax that excessive compliance, red tape, and bureaucratic delays impose on capital and labor alike. The catch, and this is where many political debates miss the point, is that deregulation can only work if other economic conditions aren't simultaneously pushing costs higher. If trade policy, labor restrictions, or tariff regimes are tightening the screws on supply and workforce participation, then those inflationary forces can overwhelm the deflationary benefits of deregulation. That's why recent financial commentary has stressed that while deregulation is conceptually powerful, its practical effectiveness depends on confronting, not ignoring, the other factors at play in the economy. Investors and markets internalize this. They aren't just reacting to headlines, they are pricing in the net effect of all policies. Easy monetary policy, for example, may temporarily boost equities because it makes capital cheaper, but it doesn't inherently fix underlying structural issues related to labor supply or production costs. In contrast, policies that tangibly increase productivity change the long-run trajectory of growth and, over time, can anchor inflation expectations in a way that monetary policy alone can. What matters in the final analysis is this. Deregulation is not a standalone solution. It's a necessary component of a broader strategy for sustainable growth and price stability. Markets will reward clarity, efficiency, and policies that genuinely reduce barriers to economic activity. Conversely, they will punish half measures that generate short-term noise without addressing the deep forces that shape prices and incentives. That dichotomy is central to understanding why capital flows and investor expectations react the way they do to economic policy signals. When you talk about monetary policy in the context of today's markets, the most important principle isn't abstract theory. It's the independence of the central bank and how that independence anchors investor confidence and long-term expectations. Right now, there's a very real debate unfolding about who will lead the U.S. central bank and what that leadership will mean for markets, for interest rates, and for the credibility of monetary policy. This is not academic chatter. Markets are pricing every nuance of this debate into bond yields, risk premiums, and asset valuations. At its core, the Federal Reserve's independence isn't a luxury, it's a structural necessity. A central bank must be free from political influence so it can make decisions rooted in data and long-term stability, rather than short-term political expediency. When you conflate political objectives with monetary policy, you don't just undermine confidence, you risk inflation expectations becoming untethered. History has shown that when political pressure seeps into rate setting, inflation tends to rise and investors demand higher risk premiums to compensate for uncertainty. What's unfolding now is significant because the frontrunner to lead the Fed is someone deeply connected to the White House economic agenda. Prediction markets, which have a strong track record of anticipating political and economic outcomes, are assigning high odds to this candidate becoming the next central bank chair. That alone tells markets that conditions could shift toward a more accommodative stance. And as we know, expectations of future rate cuts or policy shifts are one of the strongest drivers of asset prices today. But here's where nuance matters. The frontrunner has publicly reinforced that while the president's views are important, they should not dictate rate decisions, emphasizing the role of consensus and independent judgment in the Federal Open Market Committee. This emphasis is not just rhetoric, it's a direct response to market fears that political objectives could dominate monetary policy decisions. By framing rate decisions as matters of economic data and committee consensus, the candidate is pushing back on the idea that political influence will dictate the Fed's actions. Yet markets remain cautious. Bond yields have been reacting to this interplay between political signals and central bank independence. Some investors are pricing in aggressive rate cuts under new leadership, while others are wary that excessive dovishness could stoke inflation or weaken the currency. This tension reflects the larger reality that credibility, not just policy direction, matters most. If investors begin to believe that the central bank's independence is compromised, they will demand higher yields on long-term debt, which could raise borrowing costs for businesses and the government alike. What's at stake? ISN just the next monetary easing cycle. It's the perception of the U.S. financial system's resilience and impartiality. A central bank seen as independent today is what gives markets the confidence to allocate capital for 5, 10, or 20 years into the future. Once that perception is weakened, it's incredibly hard to restore. So when policy discussions start focusing on who leads the Fed and how insulated that leadership will be from political pressure, markets are listening and acting accordingly. In short, the debate over central bank leadership is far more than a personnel change. It's about preserving a system that allows monetary policy to respond to economic realities rather than political imperatives. And that distinction is what underpins stable financial markets and sustainable growth. When you look at the market today, you see more than just stock tickers. You see a story being written by bond markets. And make no mistake, the bond market always speaks first. The reaction in fixed income isn't emotionless. It is a precise barometer of real economic stress, inflation expectations, and risk appetite. When yields rise and prices fall, it's a signal that investors are reassessing risk, price stability, and the future path of the economy. That signal is loud and it's clear. Markets are uneasy. We've entered a period where bond markets are no longer placid safety valves. Instead, they are reacting violently to policy uncertainty. The massive 30 trillion US debt burden, coupled with persistent fiscal deficits that hover near 6% of GDP, keeps long-term yields elevated. Even when short-term yields stabilize or fall, the underlying tension remains. Investors demand higher compensation for holding long maturities as a hedge against inflation and fiscal risk. The concept of bond vigilantes didn't die in the textbooks. It only went dormant during the ultra-low interest environment of the past decade. When investors perceive inflation risk, fiscal imbalance, or policy incoherence, they sell bonds, pushing yields up and tightening financial conditions as a result. This dynamic is not just theoretical jargon. It's observable in the yields on U.S. Treasuries and the reaction of both domestic and global fixed income markets. As yields climb, borrowing costs rise across the economy, making financing more expensive for corporations and governments alike. This anxiety in bond markets has a ripple effect. Traditional portfolio strategies, long hailed as the 60/40ths rule, where bonds cushion volatility, are no longer behaving as expected. In an inflationary environment, bonds lose value because their fixed payments erode in real terms. That means bonds can move in tandem with equities instead of counterbalancing them. As a result, diversified portfolios are no longer guaranteed to provide the protection they once did. There's also a profound psychological component. Markets are forward-looking. They anticipate what will happen 6 to 12 months ahead. When inflation indicators rise or fiscal policy appears unsustainable, investors immediately adjust their expectations. They push yields higher to compensate for inflation risk. And that adjustment itself can generate a tightening of financial conditions. You don't have to wait for the data to confirm what markets already expect. What's more, the interplay between monetary and fiscal policy creates an even more sensitive environment. If investors begin to doubt the central bank's commitment to controlling inflation, or if fiscal policy signals higher deficits, bond yields respond. That's because the risk premium embedded in fixed income increases and the cost of future borrowing escalates. This is why even a small shift in inflation data or policy guidance can rattle markets and prompt sharp moves in yields. So when we talk about investor and bond market anxiety, we're talking about the financial system's early warning system reacting to economic and policy risks in real time. Markets aren't irrational here. They are responding rationally to persistent uncertainty. Elevated yields, volatile bond pricing, and shifting correlations across asset classes all tell the same story. Investors are paying attention, and they are pricing risk accordingly. That's why watching the bond market isn't just wise, it's essential for understanding where the economy and markets are headed next. When you analyze a company like Kraft Heinz, what matters most isn't nostalgia for iconic brands. It's how the business adapts to changing economic realities and consumer behavior. Over the past year, Kraft Heinz has clearly shown that it is in a period of strategic transformation driven by market pressures and structural challenges that go beyond short-term quarterly results. First, let's look at the hard performance data. Kraft Heinz's revenues and organic net sales have declined across multiple reporting periods. In 2025, with top-line metrics falling in both the first and third quarters and margins showing mixed signals as cost pressures persist. Kraft Heinz Company News One declining sales in a consumer staples company are not just an accounting footnote. They reflect deeper shifts in consumer demand, inflationary pressures, and competitive disruption. In an era where shoppers increasingly seek better value or healthier alternatives, traditional packaged food makers face headwinds that are structural, not cyclical. In response to this environment, management has pursued a bold strategic pivot, a planned separation into two distinct companies. One will concentrate on sauces, spreads, and other high-visibility brands, while the other will focus on grocery staples. Kraft Heinz Company News. This is not a cosmetic restructuring. It represents a fundamental rethinking of how the company organizes capital, allocates resources, and competes in a landscape where one size fits all. Strategies no longer work. Investors watching this move are essentially being asked to evaluate two separate bets rather than one monolithic enterprise. What's significant here is the logic driving the split. Each new entity can tailor its strategic focus, capital allocation, and growth initiatives to its specific market dynamics. That could unlock efficiencies and sharpen competitive positioning, which is precisely what markets reward. Kraft Heinz Company News, but this isn't guaranteed. Execution risk is real. Structural separation carries transition costs, potential disruptions in supply chains and sales channels, and the challenge of sustaining brand strength across two publicly traded entities. Market reaction so far has been telling. Stock prices have shown volatility around leadership changes and strategic announcements, suggesting that investors are digesting not just the separation itself, but what it implies about the company's future earnings power and growth prospects. Yahoo Finance. When markets respond to corporate strategy in this way, it reflects a deeper question. Do investors believe the move will unlock genuine value, or are they pricing in skepticism about the company's trajectory? Responding to this skepticism requires credible leadership, a clear execution roadmap, and an unwavering focus on value creation. Kraft Heinz's leadership changes ahead of the split, including bringing in executives with experience in leading complex consumer goods businesses, signal that the company recognizes the magnitude of the challenge and is positioning itself accordingly. At the end of the day, the Kraft Heinz story illustrates a broader truth about markets, strategic clarity, operational discipline, and adaptability to shifting consumer patterns are what determine whether an enterprise thrives or stagnates. In an environment where legacy companies confront changing demand, the ability to reinvent and restructure with purpose, not just strategy on paper, is what separates winners from laggards. So, as the policies shift, the markets react, and the corporate giants reposition themselves, one thing is clear: we are living through a pivotal moment. Every decision, every announcement, every move in Washington and on Wall Street is setting the stage for what comes next. And the consequences will ripple through portfolios, businesses, and daily life. The question isn't whether change is coming. It's whether you'll be ready when it hits. Stay alert, stay informed, and watch closely, because the next chapter of the market story is about to explode, and you won't want to miss a second of it.